Hello and welcome to this Moneycontrol live feed. You're watching Morning Trade with me, Nandita Khemka. Over the next 30 minutes, we'll be talking about the cues for trade, the big earnings to watch out for today, and we'll also be getting all your stock-related queries answered by our technical expert on the show. So if you have any stock-related queries, send them in to us on our YouTube feed and we will have them addressed by the guest. But before we do all that, let's take a look at the top headlines at this hour. Mixed news coming in from Wall Street, with the S&P 500 finishing slightly below the flat line as earnings take center stage. Fed's beige book shows the US economy saw little change in recent weeks after the banking turmoil of last month. Asian markets largely lower as investors continue to take stock of US corporate earnings. The SGX Nifty is signaling a mildly positive start for the Indian market. IT major HCL Tech is all set to report its fourth quarter numbers today. Constant currency revenue growth is expected to see a decline weighed down by seasonal weakness in the software business. And India's second Apple store is all set to open in South Delhi today. Ahead of the launch, CEO Tim Cook meets Prime Minister Narendra Modi. Sources say that Apple has sought continued policy support to scale up its operations. India's second Apple store is all set to open in South Delhi today. Of course, we will be getting you live coverage on that 9:30 a.m. onwards. So stay tuned to Moneycontrol for that. Well, let's bring on board our technical expert for today. Kunal Shah of LKP Securities is with us. Good morning, Kunal. We've seen the Nifty clocking a 3 straight day of losses after a 9-day winning streak. But in this morning, SGX Nifty is hinting at a start above that 17,700 mark. So in light of that, do you expect Nifty to start in the positive and remain above that level today?
Good morning, Nandita. I think exactly what we have seen in the Nifty index from 16,800, we have seen a rally towards 17,800, a 1,000-point move. And in the last 3 days, we have witnessed some profit booking or correction from the higher levels. So this is the nature of the market. Whenever you get a steep rally, correction is bound to happen. Majorly, this correction was contributed once the Infosys, the TCS, IT giants came out with results which were below par, and that is when Nifty started to witness some selling pressure. Now for Nifty, 17,700 continues to be an immediate hurdle. Even in yesterday's trading session, we saw 17,700 and 17,800. These were the two strikes on the options front where good amount of call writing was done. Now today being a weekly expiry, the market is likely to be highly volatile. If in the opening trade, we sustain above that 17,700 mark, we can expect some short covering toward that 17,800 zone. But if 17,700 is not taken out and we again see a drop down, we might again go into that consolidation phase and test that 17,600 levels on the downside. So I think for Nifty, the view is still not clear. One has to wait for the opening session. How does it play out? If 17,700 is held, then go for long side. If not, then probably one can create short positions as well. When I talk about the Bank Nifty index, that is where the real strength is still visible. We have not breached that 42,000 mark on the downside. So 42,000 is a very good support for the Bank Nifty. So for Bank Nifty, if you get any dip, that would be an ideal opportunity to buy Bank Nifty around that 42,000 mark. One can keep a stop loss of 41,800 on the downside and can expect some recovery towards 42,200, 42,300 levels on the upside. So Bank Nifty is one index which I'm positive on. Nifty might be sideways, or one should wait for the opening action and then take a clear-cut decisive move.
Right, so those are the levels to watch out for on the Nifty as well as the Bank Nifty. Kunal, we'll come back to you in a bit, but let me also bring on board my colleague Haripriya Suresh to put into perspective as to what we should be expecting from HCL Tech's Q4 performance. Good morning, Haripriya. Good to have you on the show. Well, we saw a pretty weak, set of numbers coming in from both TCS and Infosys. Do you expect HCL? Do we expect rather HCL Tech to also hand in a flop show when it comes to earnings?
As opposed to say TCS and Infosys, HCL was already not expected to have like a great show for Q4. I mean, there are numbers the estimates that were even prior to TCS and Infosys that were not quite inspiring, if I might say so. We obviously know that, TCS revenue growth came in at 0.6%. Infosys obviously fell by 3.2%. This is constant currency revenue growth quarter on quarter. For HCL, on the other hand, it was already expected to degrow by by 1.9 to 2.1%. Some estimates also put it at 1.2%. But largely across the board, Q4 revenue growth in constant currency terms was expected to decline, primarily because of seasonality in their products and platforms business. This is something that even the management had told us last quarter in their commentary. They said that it had peaked in Q3 and there's seasonality in Q4, and that impact will be seen. Also, at the same time, that net profit is also expected to decline about 4.5%, about 4.8% sequentially from last quarter. So that's not, the numbers itself already accounted for the fact that this is a seasonally weak quarter for HCL, even apart from all the larger macroeconomic challenges that we have. Margins also are expected to contract by about 120 basis points quarter on quarter, primarily again because it's being impacted by the products and placements business, and that would that basically offsets any gains they would have gotten from easing supply side challenges, etc. So the numbers in themselves were not. The numbers were cautious in the beginning, and the seasonality was expected. Because given it's a seasonally weak quarter for HCL, we have to see that if the show will be like Infosys or they meet their guidance and the estimates.
Right. Just to mention here that JP Morgan had already put HCL Tech on negative catalyst watch, citing near-term risks ahead of its earnings, right? So we are expecting a very weakish quarter, as you mentioned, due to seasonality factor as well as the macro headwinds. But let's also talk about guidance. TCS doesn't really give guidance. We all know that. Infosys conservative, but this time the guidance was extremely disappointing, right? So are we expecting a very weakish kind of guidance from HCL Tech as well?
In terms of guidance, I think we're expecting on similar terms, like guidance for FY24 for HCL. We're expecting constant currency revenue growth. The estimates range between 4 to 6% and 5 to 7%. This is obviously significantly lower than what they've guided for FY23. For FY23 in Q3, they also narrowed their margin guidance as their guidance band for both margins as well as revenues. Revenues they said will be 13.5 to 14% in FY23, and the guidance expected for FY24 is, like I mentioned, 4 to 6 to 5 to 7%. EBIT margin guidance also they had narrowed for FY23 to 18 to 18.5%. Similarly, for for FY24, the guidance is expected to be around 18 to 20%. So that's the guidance we're looking for. I feel like, given the caution in the environment and given the uncertainty, we cannot expect anything more than this. This is likely what's likely to be the guidance that we can get from the management later today.
Right, Haripriya. What about the management commentary? We saw TCS flagging off the fact that customers are tightening their purse strings. We heard about deal ramp downs from Infosys. What would you be watching out for when it comes to management commentary from HCL Tech?
In terms of management commentary, especially with TCS and Infosys, like you mentioned, we had ramp downs, but Infosys also spoke about cancellations. Both have spoken about an impact. So obviously, that's going to be an industry-wide phenomenon. It's not just going to be TCS or an isolated TCS or Infosys phenomenon. So what obviously we will look for in the commentary is the guidance, the impact on discretionary spends, because we have seen slowing, and essentially what the impact of discretionary spends will be on the ER&D business of HCL Tech, and what the exposure to impacted verticals will be in terms of looking telecom, high tech, retail, BFSI, obviously given the banking contagion. We're also looking at the margin levers as well to see. So obviously supply side challenges have eased. We have noticed that attrition has started to come down. So in Q1 and Q2, HCL's attrition was 23.8%. In Q3, it had fallen to 21.7%. And that figure is expected to trend down as well. They haven't changed their the fresher hiring target for FY23, but will also be seen if they're actually looking to meet it, or they have enough people that they don't need to hire anymore, or if they're even backfilling attrition. Like we noticed in the case of Infosys, they ended the quarter with 3,600 fewer employees. So and it'll be interesting to see in terms of the hiring front what HCL does in Q4, as well as what they talk about in terms of on the hiring front for FY24. TCS had a had stronger hiring plans, but Infosys, on the other hand, did not say anything because they said, that utilization is low and they have headroom. So it'll be interesting to see what HCL does on that front, given not just in terms of fresher hiring and how their attrition looks like, but given supply side challenges are easing, should be interesting to see what they do there. Apart from this, obviously, we will look at the deal pipeline. Are they seeing slowdowns? Are they seeing ramp downs? Is there delay in closures? What the deal activity is like, what the deal pipeline is like. Is it skewed more towards cost takeout and vendor consolidation? What the impact on discretionary spending is? These are all the things that we'll be watching out for during the commentary today.
Right. Well, we will be watching out for HCL Tech's Q4 numbers, and of course, we'll be getting you live coverage of that in the evening as well. So do tune in. But with that, Haripriya, thanks a lot for taking out time and joining us and taking us through what to expect from HCL Tech. Well, on that note, let's go back to Kunal and ask him his views about the entire technology pack. Kunal, we are getting some queries also on our live feed. Kamesh Sharma has written in and he says that Infosys. He asks whether Infosys should be added now, given the fact that it has shaved off somewhere around 13% over a week. Do you think this is the time to actually accumulate this counter?
See, if I firstly talk about the entire IT space, the Nifty IT index has already given us a breakdown on the technical chart. So I think more downside is there for the entire IT pack. Specifically, if I talk about Infosys, I think the downside is still left. There was a broad support for the stock, which was at 1320 level, which had got broke with the results what it came out. Now the support which has got breached, I expect the downside to continue further. Obviously, we will get some pullbacks into the stock, but to add at the current levels, I will definitely say a no, not to add. In fact, whatever rallies you get in the stock, utilize that rallies to exit. We expect the stock again to come down towards the 1150, 1100 mark on the downside. So it's a sell on rise approach. No need to add at the current levels.
Well, sell on rise is the call on Infosys. Let's also talk about the brokerage call of the day. Goldman Sachs has come out with a report on Concor. It has upgraded the counter to buy from neutral and has kept a target of 720 rupees a share. The upgrade is largely driven by the fact that it is a beneficiary of rail containerization, which is expected to accelerate going forward. And upgrade is also driven by the fact that it has a dominant market share in India's rail logistics. And in fact, Goldman Sachs expects a 15.5% earnings CAGR for FY23, FY25 with healthy cash generation. It also believes that the company is at an inflection point currently. What would your call on Concor be, Kunal?
So I think definitely if I look on the technical charts, 4 to 5 days back, the stock had given us a breakout from a falling trend line. We had seen a sharp correction in the stock from the levels of 800 to the levels of 550 on the downside. It's definitely trading in an oversold territory. A breakout has already been confirmed on a technical chart. Utilize dips to buy the stock. Even at current levels, one can start to accumulate. The best way is to accumulate the stock in a phase manner. The support what I see on the downside is somewhere around 580 zone. So as long as 580 is not breached on the downside on a closing basis, I expect the stock to move higher. So probably the 600 to 580 zone would be an ideal range to add on to your portfolios. We expect the stock to move higher towards that 650, 660 zone on the upside. So definitely it's on a buy list from the current levels.
Right, definitely on the buy list. Let's also talk about some earnings candidates then. ICICI Securities has reported a weakish set of numbers. Profits have declined over 20% on a YOY basis, and the operating performance and top line both have been pretty weak for the company, right? If you look at the stock, it is just coming out of 52-week lows and, has been in a downtrend over the last, in fact, on a YTD basis, it has lost somewhere around 6% or thereabouts. Time to look at this counter, or is it time to just stay away from this one?
Exactly, Nandina and Ananta, as you talked about that, the stock is currently trading in a strong downtrend. Since it was trading in an oversold territory, we witnessed a pullback rally. Now, post this pullback rally, the resistance what I see for the stock is at 470. As long as 470 is not taken out on the upside, we might see continued selling pressure in the stock. So view remains bearish. One could probably sell the stock even at the current levels. Downside targets, what I'm seeing for the stock are somewhere around 442 to 445 levels.
Right. We already spoke about IT per se, but, in the mid-cap IT space, we had Mastek reporting earnings, and the earnings have been pretty good if you compare it to its large cap peers, profit has jumped over 13% on a QOQ basis, which is driven by strong operating income. And we are getting some queries on some of these mid-cap companies like LTI, Mindtree as well. Guddu Bala Subramanian also wants to know your thoughts on this. So how would you view some of these mid-cap counters like Mastek and LTI, Mindtree now? Which one would look better on the charts?
See, I think firstly, if I talk about Mastek, the stock has been trading in a strong downtrend. The actual breakout for the stock will come above the levels of 1700. That is where we'll get a falling trend line breakout as well. So that will confirm that my entire downtrend is over, and then we'll see a good move on the upside. So I think at the current level, one should avoid Mastek, whether on the long side or whether on the short side. It might again keep on consolidating in this broad range where 1500 is my support and 1700 is my resistance. So this 200-point range is what I'm expecting the stock to trade into. Once we get a breakout above 700, that will give me a confirmation. 1700, that will give me a confirmation that the stock is likely to head toward 1900, 2000 levels on the upside. Similarly, if I talk about LTTS, again the stock is trading near a very critical support zone on the downside on a technical chart. So 3272 has been a very strong support for the stock. Whenever the stock has come over these levels, it has again seen a very good bounce on the upside. So I think a good risk to reward ratio, what you're getting at the current levels, one can initiate long positions with a stop loss of that 3272. We can expect a gradual recovery toward that 3500, 3600 mark on the upside.
Right. Kunal, what about Tata Communications? The numbers aren't all that great. In fact, profit has dipped somewhere around 10% on a YOY basis. Revenues are up 7% driven by its data services business. But if you look at the stock, it's been pretty weak and has lost somewhere around 7% in a matter of 5 days. More weakness on the charts?
Yes, definitely. If I talk about the chart perspective, on 29th of March, the stock had actually given us a breakout from a falling channel. And post that breakout, the stock from 1200 levels went up to that 1300 mark on the upside. But post that 1300 mark, we have continuously seen selling pressure and the stock has again breached that 1200 support as well. The decline is likely to continue. The next support for the stock on the downside is somewhere around 1150 zone. So 1150 is what I'm expecting the stock to test into. One could probably sell the stock as well, keep a stop loss of 1235 on the upside, look for targets of 1150 to 1140 on the downside.
Right. So those are the levels to watch out for on Tata Communications. Kunal, a lot of queries coming in on the realty space. We've seen some of these realty counters starting to participate, in the up move. And DLF and Oberoi Realty are some of the counters that our viewers want to have their queries addressed on. So Matthew Longshank has queries on DLF and Mahim Kumar wants to know your thoughts on Oberoi Realty. Among all the realty stocks, which are the ones that are looking good, and what about Prestige Estates as well? Among the three, which one would you prefer?
So firstly, Nandita, I will talk about the reality sector. Now, the reality sector was trading in a deeply oversold territory. In the last 10 days, when the Nifty had rallied, it was the Nifty Reality Index, which was a major outperformance. Now, this was supported by a lot of data. We just had the RBI policy, where a lot of people were expecting a 25 basis rate hike. But we had a status quo on that. This is the first time where we can probably see that the rate hike might stop, or it might again stay at the same level. That is, the pace of the rate hike might not increase very aggressively. That's the first positive sign for the reality sector, and that is where the buying momentum is clearly visible. Now, the index from the levels of 370 has witnessed a rally towards 430, what you can say almost a 15-20% upside move, what we have got in the 10 days. Now, the index is facing near a very critical resistance of 440. The undertone remains extremely bullish. I'm bullish on the sector per se, but I think at the current levels, the risk reward is not very favorable. Probably utilize declines to buy the reality index if you get any correction. That would be an ideal opportunity to add long positions on the entire reality space. My top pick from the reality space would be DLF. DLF on the technical chart has given us a strong breakout with volumes. Again, the stock, which was trading around 365, 370 zone, has rallied toward 420. Now, the support for the stock is somewhere around 406, 410 zone. So if you get a dip around this zone, definitely it adds into your portfolio. I'm expecting levels on a positional basis of 500 to 525 on the upside from this entire breakout, what we have got into. So DLF definitely remains a top pick as well. You talked about Prestige. I think Prestige has seen some buying momentum in the last 1 to trading sessions as well. I'm much more bullish on DLF, but even Prestige charts looks very good. If one has to initiate long positions, keep a stop loss of 436 on the downside. We can expect a gradual recovery towards 472 on the upside.
Right, so that's the thoughts. Those are the thoughts on the realty pack. But I want to get in your thoughts on fact. This stock has gained 40% in the last 5 days, even though yesterday it was pretty muted. We have a query from Debu K, and he wants to know whether it's the right time to book profits after the kind of rally that we saw.
See, I think fact definitely the rally what we have seen in the entire fertilizer space has been massive. Specifically, fact has been a big outperformer. Now the stock is trading near a resistance zone of 350, 360 kind of a levels. Whenever the stock has come at these levels, we have witnessed correction. So I think definitely a good time to book a profit if you are holding long positions. If you get any rallies toward that 335, 340 zone, ideal opportunity to exit. Probably you will again get a dip into the stock which you can utilize to buy into. So the next, again, if the downside profit booking comes, it might come toward that 280, 290 zone, which would be an ideal opportunity to add long positions. So definitely one can at least book profit those who are holding long positions.
Right, I think we just have time for about one more query. So I will take this on the pharma pack. Karthik Raja has written in, and he wants to know your thoughts on Sun Pharma, given the fact that a lot of brokerages are now turning bullish on some of these large cap pharma counters. Even though Sun Pharma hasn't really done much in yesterday's session, what would you advise investors to do with this one?
I think firstly, if I look at the Nifty Pharma chart, I think Pharma chart has made a very good bottom on the downside. We have seen good amount of buying from the lower levels in the entire pharma sector. So you can say probably more or less a bottom is confirmed on the downside. I expect pharma to outperform in the year 2023. It has been a massive underperformer since the last 7 to 8 years. So finally, we are seeing some kind of strong buying over here. If I talk about Sun Pharma, again, the chart is looking mildly bullish to sideways. The real momentum for the stock will start to pick up once it breaks about 1020. So 1020 has been a resistance for the stock. Whenever it has touched those levels, we are seeing selling pressure. So for Sun Pharma, if you are holding long positions, keep a stop loss of 970. You can probably add at the current levels in a phased manner. The real momentum will start about that 1020 breakout, what you will get into the stock.
Right. Well, that was a thought on Sun Pharma, but we are completely out of time. And before I let you go, Kunal, leave us with some stock recommendations for the day.
See, I think definitely, as I told you, there are a lot of opportunities from the mid cap and the small cap space as well. We expect the market to continue and rally on the upside in the very short term. The first pick will be from the fertilizer space. As we talked on the show as well, fertilizer is something which is looking very good on the charts perspective. Now, talking about the fertilizer space, the top pick from my end will be Coromandel. Coromandel has given yesterday's trading session a strong breakout with sharp surge in volumes as well. The F&O data too suggests long build-up positions were created in the stock. I expect this momentum to continue towards on the higher end towards that 975 zone on the upside. The lower end support for the stock is at 925. So one can initiate Coromandel as a long with a stop loss of 925 for targets of 970, 975 on the upside. My second pick will be from the oil and gas space. Now, recently, oil and gas space I have been also buzzing around the street. I expect ONGC to be an outperformer in this case. The stock is on the verge of a big breakout. The stock support on the downside is at 156 zone. So as long as the stock sustain above this level, we expect the recovery toward that 165, 168 mark on the upside. Currently, the stock is trading around 160. So ONGC is a buy at the current levels. Stop loss will be 156. Target will be 165 to 168 on the upside.
Right. So those are the stock recommendations coming in for Kunal for this morning. With that, Kunal, thanks a lot for taking out time and sharing your thoughts with us this morning. Well, we are completely timed out on this edition of Morning Trade, but don't go anywhere because coming up next is Opening Bell. And of course, stay tuned to Moneycontrol because we'll be getting you all the live action from the second store opening of Apple in South Delhi.